Group Statements, Chapter 7, Example 7.1. Example 7.1 looks at the scenario where there's a revaluation necessary on a non-depreciable asset of the subsidiary at acquisition date, and the value adjustment is recognized in the records of the subsidiary before we consolidate. So P Limited acquired 100% interest in the net assets of S, and my acquisition date is 1 January 20X9. On this date, in the trial balance, you can see that the property, plant and equipment land of the subsidiary is measured at 100,000 Rand. The second bullet of the additional information is what we will look at now. On 1 January 20X9, so my acquisition date, the identifiable assets and liabilities of S were considered to be fairly valued, except. Now, the moment you see this word except, you should now realize you are in Chapter 7. There is some or other asset or liability of the subsidiary that's not fairly valued, that needs a value adjustment, and we need to investigate how to deal with that for consolidation purposes. In this example, it is the non-depreciable land of S that was undervalued with 20,000 Rand. So that land up in the trial balance of the subsidiary, the 100,000 is undervalued with 20,000 Rand. It is the accounting policy of S to account for this land in terms of the revaluation model of IAS 16. So it could be possible for S to recognize this value adjustment in the separate financial statements of S before we consolidate. However, you still need to see whether that has happened or not. So if you read on, the directors of S therefore decided to revalue this land at acquisition date upwards with the 20,000 Rand in the separate financial statements of S. And this would have happened before we consolidate. So in the records of S Limited, the following journal entry was processed before consolidation happened. Land was debited with 20,000 Rand, so it was increased, and a revaluation surplus was recognized through OCI for that 20,000 Rand. Please note, the above journal is not a consolidation journal entry. It is accounted for in S Limited's own accounting records. After this journal has been processed, the net assets or the equity at date of acquisition are equal to fair value. And that was the whole purpose of having to recognize this journal. So S Limited's equity now consists of three components at acquisition date, being your share capital, retained earnings, and this revaluation surplus that you've created in the records of S through this journal entry. As a result, your at acquisition consolidation journal entry would be as follows. You would debit the share capital and retained earnings of S, which you've seen in all your previous examples. And now there is a new equity item that also has to eliminate together with the rest of the equity of the subsidiary at acquisition date, being the revaluation surplus of 20,000 that was recognized in the separate financial statements of S. Against that, you eliminate your investment by the parent. If the subsidiary didn't value adjust the land, there would not have been this resultant revaluation surplus. And as a result, the at acquisition consolidation journal would have generated goodwill of 20,000, and that would have been incorrect. In all the examples in Chapter 7, you will note the heading Business Combination Valuation Journals. And this is where we have to decide whether there's additional consolidation journal entries necessary before we do the at acquisition journal. In this example, there isn't any further consolidation journal entries necessary because S already accounted for the value adjustment in the separate financial statements of S before we consolidated. But I want to show you how we can use that suggested work method that I've mentioned in video 1 to conclude that there's no business combination valuation journals necessary, as we're going to keep on using that work method in all the subsequent examples. In example 7.1, the carrying amount of the land was 100,000 in the separate financial statements of S. Then the additional information indicated that a value adjustment of 20,000 was required. This 20,000 value adjustment was recognized by S in the separate financial statements of S. As a result, the adjusted carrying amount was 120,000. That is equal to the required measurement of this land in the group financial statements. So when you now look at your differences column, you will see that there's no differences between what S recognized this land at in the separate financial statements versus what is required for the measurement of this land in the group financial statements. Therefore, we conclude in example 7.1, there's no business combination valuation adjustment journals necessary as part of the consolidation process before we do the at acquisition journal. In example 7.1 that we've looked at just now, the consolidation and the at acquisition consolidation journal entry was done immediately after acquisition on 1 January 20X9. The question is now, would it have made a difference if the consolidation was done at 31st December 20X9 or even 31st December 20X10? The answer is no. The normal consolidation procedure, as we've looked at in Chapter 2, for a consolidation at any date since acquisition will be applied. The revaluation of the land was recognized in the subsidiary's own accounting records on 1 January 20X9, which was the date of the acquisition, so that revaluation surplus will always form part of the at acquisition equity of the subsidiary.